Okay, good evening. Welcome to the sixth class of QuickBooks 2020. I'm going to start off by reviewing the problem that I sent in the email, being that we've already been analyzing the balance sheet and the P&L reports. So we are right now still remembering what our assets, what our liabilities, what our expenses, and we did a general journal entry last time, moving the $1,500 check around. So I'm going to bring up on the screen for those who have been looking at it. A second, it was in the email. Okay, we'll share the screen. We'll bring it up over here. So we have here, okay, till that we've been talking about a company. We didn't know who the person is owns the company. Now we have a name. The name is Ruvain. He's a CEO of We Do It All. And he just came back. He was by an open house, and he's buying a summer home to rent out. The home costs $200,000. He's going to put down $20,000. He will get a mortgage. It's going to happen right away because it was pre-approved. And the mortgage is $180,000. So between his down payment over here, which is the $20,000, and the mortgage, which is $180,000, he'll be able to pay for the price of the home. But there's more money that's needed just than the face value of the house, which is $200,000, because as everyone knows, or people will know, when there's closing fees, and we just use round numbers, which may or may not be, depending on where you are, how much it will cost. But we just took numbers to get you the idea. This closing fees of $2,000. There's $500 short interest, which is what you prepay when you're in the middle of a month. You pay out for the money in advance. And let's say, for example, he's doing this purchase in June. So he's going to pay in advance for the money, which he's borrowing. He's borrowing the money from the bank on $180,000, let's say June 10th. So he's borrowing the money from June 10th until June 30th. So he's going to prepay that short interest. What about the money that he borrows the July? So he borrows the money for July that he's only going to pay in August. Okay, so he borrows the money in June, the 10th of June. He is going to pay in advance for the borrowing of the rest of June. And July he'll pay on August 1st. So we don't know what he's going to pay in August 1st. It's not important. What's important is that today he's paying $500 more, which is interest. He's also is joining an association. He's going to pay $2,500, which is going to cover the maintenance of the property and other expenses of the common areas of his colony or his association. And he also has to pay a property tax of $2,700. And we asked, what is the debits and the credits? So let's first explain this in terms of assets and liabilities. And we said owner's equity goes up and down by expenses. Obviously, there's no income here. There's only expenses. So all of it is not expensive right off. It's you put the money down, it becomes an asset. So when he puts down the $20,000, again, it's double entry. What's going to happen? The company is getting an asset of the asset we're getting now is a house. The house is $200,000. So that will be the debit. The debit will be $200,000, the house. And after I go through this, I'm actually going to show you the journal entry. I'm going to bring it up also on the screen. And I'm going to email to you also, so you also have that as well. And we could do this afterwards. We could do it actually together in QuickBooks. But right now I'm just explaining the problem first. So we are gonna the We Do It All is buying a house as investment. We're gonna have an asset of $200,000. Now we know that assets equals owner's equity and liabilities. So his owner's equity is going up by 20,000. And then there's be a liability of 180,000. That's going to be what he's borrowing from the bank. So the 20 and the 180, that equals out to $200,000. But that's all he borrowed from the bank. Everything else he's going to pay is the additional owner's equity that he's putting in. So if he's going to pay a closing fee of $2,000, so we're going to discuss that closing fees is not actually an expense. It's added to the value of the house. The house is $200,000. We give an additional asset of $2,000 because that's part of the house itself. But his owner's equity will also go up by $2,000. The $500 interest, that is actual expense because it's not part of the house. That's if you had the money, you would pay it up. You would still pay the $2,000 closing fee, but because you borrow the money, you have an expense of $500. And then association fees is an expense, and property tax is also expense, which will further bring up his owner's equity, his members' equity. So I'm going to bring up now the journal, and we'll see how this goes in. Let's see here. Let's share the screen for the QuickBooks. Okay, so right now I'm going back to make general journal entries because this is what we're going to do. We have the company. Company, it doesn't make a difference if you're in the balance sheet or you're at the home page. You can always access your menus from whichever report you're in. Go into company and make general journal entries. In the process, so we're going to create owner's equity account. I know in the past we used what's called members equity, and QuickBooks is giving us a message. They wanted us to create a different account. So we're going to create now Reuven's equity. I'm going to change the date today to June 5th, 06, 05, because we're going back to the summer. And we are going to create what's called an asset called summer home. So again, to create an asset, you just type, and it's going to ask you what, if it's a new account, what you want it to be. So we're going to type in summer home, and that's what QuickBooks is going to ask us. Setup. We're going to set up a new asset called summer. You don't see it right now in the drop down. You have income, you have expenses, and on the second line, the second section, you have what are called, like I said, these are the balance sheet accounts. The top is income and expense because that's what's going to affect your P&L. But your bank account won't disappear in fixed assets. And it tells you here on the right side, that's what you use for buildings and land and machinery. In this case, it's a building or a home. And I'm going to select continue. I'm going to pause right after I create the asset, and for those who want to, who prefer to watch this as I go, can watch it, but I'll give also a chance for those who want to enter that journal entry as we go along. Save and close. Okay, so here I'm bringing up actually I'm sharing on the screen the journal entry so you can understand it in full and then we'll go place by place. So we're gonna have here, this also last time around we did the course. You have here the house is $200,000. Now we're calling summer home. The house is $200,000. The closing costs, we could put in the memos, also $2,000. Those are all debits. But these two debits are asset debits. The next few debits, which are homeowners and association fees, this is actual expense, $2,500. Property tax of $2,700. These are expenses. Short interest. So these are $500. On the right side are all the credits. So first we have the liability because that's what comes first. Assets, the way we write the equation is not assets equals owner's equity plus liabilities. It's assets equals liabilities plus owner's equity. And the reason is because when we have to settle, first we have to deduct the liabilities and pay them off before we have owner's equity. So we borrowed $80,000, and we have a members' equity of $22,000. The first $20,000 is what he needed to complete the purchase of the home, and the second $2,000 that is for the closing costs, which acquisition. All the fees for acquisition of the house goes into the actual value of the house, the members' equity, and for that matter, everything which is going to go into beyond what he borrows from the bank will be owner's equity. So that'll be additional $2,500 for which he put in to pay the owners association. You see here, there's a debit and a corresponding credit. We have property tax, $2,700, corresponding credit of members' equity. And then again, $500 a debit of interest and the corresponding credit of members' equity going up $500. And this we're going to do in the journal entry, with the exception that we're going to create not members' equity. We're going to create a new account called Ruvain's Equity, and I already named it Summer Home, so we'll keep it as Summer Home. I believe I could. Okay, so I think that seeing first how it's going to look, the debits and credits in entirety, it's a total debits will equal $207,700. Okay, so closing fees, I see people asking questions. Closing fee is what you actually pay a lawyer, what you pay for title companies, titles insurance. You don't just go and put down $200,000 and the owner says, here's the keys to the house. You have to pay, there's, you have to make sure there's no liabilities on the house. There's no violations. There's no liens. You don't want to buy a house for $200,000 to find out that the owner owes back taxes of $25,000 or for any amount for that matter. So that's why you have title insurance. Property tax is an expense because it keeps on recurring. It's not a one-time thing when you buy the house. Every quarter or annually, you are paying taxes on the house, and it goes up and down. So that should answer the questions of Mordechai and Anonymous. Again, how do we create a new account? We just type, and it's going to prompt you to do a new account. So now we're going to go back to the QuickBooks, and whatever you saw here on the journal entry, this is a printout of what I did in the journal. So we had summer home, $200,000. And the way it works on the account, automatically it assumes it has to balance, it has to equal. Whatever's on the debit side has to be in the credit side. The difference is you could break it up in different amounts. Not all versions of QuickBooks do this. Actually, I think they give you the debits and credits on the top, but they don't give you the total on the bottom. We know we're getting 207,700. So how we get there? We're going to create now, just type away, Reuven Equity, and press tab. When you press tab, It's going to ask you to set up. And here we're going to create what's called an equity account this time. So the first one I created, the summer home, was a fixed asset. And the second one, Reuven's equity, is an equity account. And account type is equity. Not actually, not. It's equity account, and that's his name. And what's his equity going to be? His equity is going to be 20,000. Now, in the journal entry, we had it the other way around. We had liabilities first, and that was actually borrowed from Chase. So let's keep it to that order. Actually, it doesn't really make a difference for that. Okay, I created Reuven's equity, but I'm going to move it down to the next line. And I'm going to first put in the order we borrowed. See, the then result is, it doesn't make a difference which order you put it in here. If you put the equity first, you put the liabilities first. As long as everything balances out over here and the totals are equal, when you make the balance sheet, QuickBooks by itself will know what to pull. So even if I would have put equity higher up in the journal entry is just a way of a journal, putting information. If you remember back to the first class, what would really happen is that you would enter anything in a diary, right? A guy comes home, I write in a diary, today I bought a house for $207,000. So I put down $220,000 of my own, I put down $200 for the bank, and that's the diary. Then you have to do the posting. So this is really just the diary part. QuickBooks will do the posting and pull it into the balance sheet. So I'm going to create an account called Chase account. What do we call it in the other? We call it Chase Mortgage. Okay, so we're going to call it Chase Mortgage to differentiate it from our Chase bank account. We're going to call it Chase Mortgage because that's the account. And this is going to be a long-term liability, right? So it's not an asset. It's not a bank. It is a loan, but what type of loan? So if you drop down, you could be more specific. You could take a current liability or a long-term liability. So a long-term liability is like for mortgages. Current liabilities are for sales tax or short-term, that things that you really have to pay in the next month or so, or a couple months. So yeah, you have it in the current liabilities, but we're going to take long-term liabilities. So I'm going to pause here. I created 3 accounts. I created a long-term liability called Chase Mortgage. We created, you see over here, a fixed asset called Summer Home. So we have Summer Home, which is a fixed asset. We have Chase Mortgage, which is a long-term liability. And we have Reuven Equity, which is equity. And these have to be the same amount. So if mortgage, it will be $180,000. This has to be $20,000. So far, we're total to 200. I'm going to pause here and let everyone catch up to this part. And I'm going to address any questions that come up. Actually, what I'll do is I'll also I'll re-email right now that journal entry. The date I chose for this journal entry is June 5th. But I'll just make it June 8th because that's what's going to say on the paper that you're going to get. And the beauty is that after we do this journal entry, we're going to go back to the balance sheet. I'm going to see how everything falls into place. Okay. This is what we call GJ2, General Journal 2, because this is the second journal entry that we're making. And Attached. Journal entry for okay, so you should have the received now email. For those who are still at their email, they could pull it up as well. Moving equity is equity, not an asset. Again, the equity, the asset is the house. That is the what's going to stick around, and it's not going to disappear. So when we set up equity, we choose equity. Again, that's what's the chart of accounts is key to any type of report that QuickBooks makes, because depending on what category, right? First you give a name to an account. After you give a name, since it's a new name, QuickBooks asks you, what type of account is it? What category? Is it an asset? Is it a liability? Is it owner's equity? And in that itself, it could ask you if it's income, if it's an expense. The income and expense affects the owner's equity, and it's in a separate statement, right? The profit and loss is basically all the revenue, the income that comes in, and the expenses is all the money that goes out, which is an expense. Like I gave the example, when you buy supplies and the paper is gone, when you have the electricity and the month is over and the rent, and same thing with rent, next month there's a new rent bill and there's no electricity bill. So those are expenses. Then there are assets, like you buy a copy machine, it doesn't disappear, it sticks around. It goes down in value after time you have to replace it, but it's not an expense on day one. Okay, so going back, okay, so I'm going back into the QuickBooks here. For those who created the first part of the puzzle, the first part of the puzzle is a house that's $200,000, and it's very simple. This is a equity, an asset. The summer home, a fixed asset. The Chase mortgage is going to be a long-term liability. That's assets equals liabilities and owner's equity. Reuven's equity is going to be $20,000. And that's the $200,000 we have so far. But there is a continuation to the story. And that is that we said he's paying closing fees. So we're not going to make an account called closing fees because there's no asset called closing fees. What we're saying is this is all part of the asset called summer home. So we're going to type in over here, summer home. And once I type SU, it brings up summer home because only supplies in summer home show up with the SU. Supplies is an expense, and summer home is an asset. And I'm going to put in $2,000, but this will put in the memo. So the memo will tell us that why is the asset $2,000 more than the purchase price? Because there were closing fees. That's what memos are for. You can actually put in his down payment. You could put this in, if you want to put in the mortgage, you could put in, but this is, why does he get equity? Because he put in $20,000 down payment, he paid for closing fees. When you click the next line, so it's going to already bring down, you're going to copy and move it up. This is part of his equity. It still goes up. Reuven's equity is still going up at $2,000. You could keep the memo in both places. You could keep it on one side. That's totally up to you. And then he has homeowners association. I type HOA. This is an expense because every year you could have a new expense called association. There is actually in QuickBooks, there is a repairs and maintenance. But here, maintenance is more referring to maintaining a house. It's not the actual, you could theoretically throw it into maintenance over here in the maintenance account, repair maintenance. If this, but again, depending what type of company you would have repairs in your office. You would have maintenance, cleaning your office, cleaning, maintaining the appearance of your office. The maintenance of an investment home, which should probably be flagged as its own account. So it's not rolled into the same type of maintenance. All of a sudden, you have thousands of dollars of fees and you have a little office, you want to know why is there. So you could put an HOA. And again, since you're putting HOA, homeowners association is going to ask you, what is it? This you choose expense. Again, so as we're doing a journal entry, you see we're creating multiple types of accounts. First, we created a fixed asset called a summer home. Then we created an equity account. We created what could have been a loan, but we chose a long-term liability. And you'll see later in the class, we're going to be choosing a cost of goods account, maybe the end of this class or beginning of next class. We created a homeowners association. That's an expense account, right? And again, even though you chose it, it tells you it's like you're confirming that you typed the name right and the account type is right. It brings it up in large. And this will be $2,500. And this is homeowner association. You could theoretically you could have put it also in the description if you wanted to. Again, this is the equity. If I wouldn't enter it, equity in this line, QuickBooks, I'm doing it now manually, but QuickBooks would do it for you on the following line. Okay, so right now we see the totals are still balanced. The debits equal the credits because it's always like that. Debits always have to equal the credits. Sometimes it's on the left side of the equation, sometimes the right side, sometimes it's reversing. Sometimes you're changing money from the bank into the asset. That means if I would have had $200,000 in the bank, then both debits and credits will be on the asset side. I'll be debiting the asset called summer home. I'll be crediting the asset called bank or cash. So not always the debits and credits have to be on the opposite sides of the equation, but debits do always have to equal the credits. Okay, we have two more entries to put in. One is called taxes. It's called property tax. So we're going to put in property tax. Okay, it's an expense. I could change to lowercase. Okay, so we have taxes of 2,700. Again, if I would skip the line, see here, you click it automatically. QuickBooks will put in. If you click on the box, QuickBooks puts in that it has to equal the debit, and you're going to put in again equity because this came out of Ruben's pocket. Last but not least, there's a $500 expense for interest. 500, and again, if you short interest, this is. If I'll click on the next line, it's going to put in again equity. So I'm going to keep this open. This is pretty much the same thing you saw in the email that came to you with the journal just a few minutes ago with the journal entry. I shared screen with you, and now I'm leaving it open for about 4 minutes. Anyone who wants to go back and forth and look at what entries are before I press save and close and I go over to the balance sheet. I will be looking at the Q&As while those of you who want to complete the journal entry can do so. Okay, so right now we're not going to discuss balloon payments and amortization. This is beyond this problem. Okay. Again, any money, someone's asking, why am I crediting equity for homeowners equity association? No, homeowners association is a debit. It's an expense. Expenses increase with debits. But because the money of the $2,500 was spent, where did it come from? It could only come from a liability or owner's equity. In this case, owner's equity was the liabilities was limited to the $180,000 from the bank. So if you had to guess right now, if you would look right now at this whole sheet here, and you know that the credits are 207,700 and 180 is the mortgage, it means the balance is $27,700. This is all going to be Reuven's equity. It's 20,000, it's 2,000, it's 2,500, it's 24 and a half, and another 3,200 is going to be 27,700. We'll see this in a moment. Again, if anyone had trouble, there's a clear button on the bottom right corner. You could clear out and you could start again, or you could just overwrite some of the words that you put in before. Again, this is like simplifying because usually you won't be dealing with round numbers like everything even 2,500, 200,000. And to actually get to the right number, you have to start looking through closing documents and pulling from different sections. But eventually, I'm sure those of you who will finish the course will get there and you'll be able to analyze the documents and you'll know what belongs in the asset, what belongs in the expense. And right now, by first doing a simplified version, it will help you tremendously in being able to create these journal entries. Because this is not just left for the accountant. And if you work in a real estate office, every time they have a closing, if they're buying new apartments, they're buying new rentals, they want to put assets on their books, and that will be the bookkeeper's job. So this is a very valuable lesson in how to account for fixed asset purchases. Okay, so someone else can I actually whatever you see up here, I sent to you. So that's why I changed it. I matched the date, June 8th. This guy came in the summertime. He's getting ready for July and August. He wants to rake cash in. And that's what says. I said the only minor changes from the paper I sent you was that I called it summer home and summer house instead of house, and that I called members equity now Reuven's equity to avoid QuickBooks's, which is actually correct. You should change it to Reuven's equity. So empty spaces doesn't really bother anything, but if you click on the following line as opposed to pressing tab, automatically it will be bringing up the balance, the whatever should match the debit. Okay. Okay, I didn't press yet save and close. I'm going to do it in a moment. So for those of you who live in a condo or in a in a condo, or you have maintenance charges, where do those go? That goes to the homeowners association, and it pays for all the common elements as the elevator, the building insurance, the cleaning help. And for those who have part of a bungalow colony, it's the exact same thing. You have homeowners association. If you live in a gated-in community, probably you also have homeowners association fee for the security at the gate for the parking, for cleaning, etc. Okay, so just though answering here, Reuven equity is an equity account. Equity is what the owners of the company invest, as opposed to liabilities, which the company is borrowing from outside lenders. Okay, so now I'm going to press save and close. And it says it's reminding me it's more than 90 days in the past. It's okay, it's fine. And you press OK. Now it says data that affects the purchase changed, obviously, because the balance sheet changed. Now you scroll down, we said the balance sheet will show 27,700 Reuven equity. And there you go. There you have it right there. While you're at it, what you should do is double click on the 570, where it shows members equity. And we're going to double click on the $500 that Reuven had deposited, and we'll change this from the from account also to Reuven's equity. Okay, QuickBooks prefers it that way. So again, after confirming on the balance sheet that whatever we did now in the journal entry, the 27,700 came into Reuven equity account, we're going to double click on the 570, which will bring up the deposit of 500, which we brought in from this year, because the $70 is money that we earned from last year from Fivers Glick. We're going to change what was previously members equity to Reuven equity, and I'm going to save it. So now the total amount of Reuven's equity is going to really be $28,200. Members equity will be $70. The $500 is not lost. It's merged with the $27,700. I'm going to pause here and see. Now, if you close the balance sheet, all you got to do is go back to reports on the top, and you go company and financial, and you go to the second section called balance sheet standard, and you will make sure you're choosing either this fiscal year to date is fine, or you could go to this fiscal year in total. Okay, so you have either this fiscal year or this fiscal year to date. Okay. Also, as I wrote in the last email, the difference in your balance sheet prior to this journal could have been off by $1,500. It's if you reclassify the $1,500 payment from the personal check to the company check, and previously you had $1,423 in the bank, so now you have a negative 77. That would all tie out. Okay, so that is it for the journal entry. So let me go through again the balance sheet. Let's see the asset. The asset, we have summer home 202, and that also makes sense. $200,000 the purchase, $2,000 the closing, as we said. Everything else, the other $5,700 went into the expense. You go further down, just like we accounted for the $27,700 for the members' equity, you have the Chase mortgage showing up on long-term liabilities. Now let's go back a second to the profit and loss sheet. Profit and loss sheet, refresh needed, obviously. We have here now the 2,500. Okay, that's again, if you have to make the report, go to reports, company financial, and pick the first line, which is called profit and loss standard. And again, you take this, not this month to date, this fiscal year to date, or this fiscal year. And you see here, you have the homeowners association expense of $2,500. We have the interest of $500 and the property tax of 2,700. That is the other $5,700. Right? 25 and 5 is 3,057. So that all shows up under expense. Now, it might look very sad that the net income for this year is negative 6,400, but don't keep in mind that Ruben is about to rent out his bungalow for about $12,000 for the summer season, $6,000 a month, and he will cover his expenses. 32.
32.
Yeah. Yeah. Okay. So this is it for the journal entry for how we put the asset on the. This is called putting the asset on the books. We put in the closing. We accounted what belongs in expense, what belongs in the asset area, what's in the liabilities. Yeah. And if anyone has further questions on this topic, you could stay on about 9:20, 9:30, and we will discuss this further. You also have, I emailed you the journal entry. If you need time to do it on your own, you can do that as well. Okay. Okay. So, okay, the last thing I did on the balance sheet, my balance sheet shows my members' equity $70. If everyone had this before, either it says 70 or it says 570. So if yours says 570, you double click on it, and it would bring you up a line with $500. And you double click on that, and you would change it to members' equity. Actually, probably more straightforward way to do it is you go to banking, you go to your register of Chase, and all you got to do is make sure that your first deposit of $500 says Reuven Equity, which is really all the same thing. Everything ties in. Previously, it was members' equity. We just change it from members to Reuven Equity. So there are 4 equity accounts. There's the opening balance equity, which is also a possibility, but for now we'll just stick to Reuven Equity. Members' equity is what's going to happen every year is that your value goes up in the company with the profit, with last year's profit. Whatever was profit last year is going to add to your equity. Members' draw is an account where people take money out. It's not an expense for the company. It's a way of accessing your cash or your profits before year end. And whatever you took out in your draw is not going to be expense. It's not a tax write-off, but that is going to reduce your equity at the end of the year. It's the contra equity account. So if your company, for example, made $5,000 profit and you had withdrawals of $3,000, you will pay tax on the $5,000 profit, but your members' equity is only going to go up by $2,000 because you already sucked out of it $3,000. That's without too much confusion. We're just going to save them $500 members' equity or opening equity, whichever you prefer. Just take it out of the members' equity. QuickBooks is not happy about that. So I take Ruben's equity or opening equity. So the only thing this member's equity would be the $70 from last year. This. So one more time back to the balance sheet. What is members' equity? Members' equity is the $70 that we saved from last year. If we would be in next year, our members' equity will be the combination of member equity plus this year's net income. Will be those two together. I think that's okay. I see everybody's hand. I'm gonna get that in a second. How do you switch it? If this is still applicable to Salman, you just write down Reuven equity. Again, the way you switch something is just by typing over. If the count exists, it'll change it. Okay, so I think Ms. Ringo has a question. So I enabled the speaking if you want to ask the question. Otherwise, if you want to type the question, post it on the Q&A. Hello?
Yes, hello. Okay, my balance sheet, the number is 206062. I have like totally different things than you.
Yeah. You have the 206
Mm-hmm.
012, right?
062.
So you have 206
And actually,
062.
my,
Okay, fine. Yeah, that's the $1,500 that you never corrected before the class.
how do I do that?
Okay, so you have to just go back to the journal entry, number one, which
where
is your
go?
company.
My company,
Yeah,
and
I guess
then,
I unshared the QuickBooks. Company, make general journal entries, and you go back to number one, left arrow, number one is here. Okay, it's reverse order because of the date. You just changed what was previously here, members equity, change it to Chase.
okay, I have accounts payable and members equity.
That's right, so change it to Chase.
That should
Save
be
and close,
Chase.
everything will fall into place, yeah.
So I just type in Chase.
You type in Chase.
Mhm.
A second. Why is it not?
Just plain Chase, not Chase Mortgage, right?
No, Chase.
Okay, and then save and close.
Save and close.
Okay.
And
Now I have
you'll see that now this
562.
that's fine. And your bank is negative 77. That's perfect.
204562. That's okay.
Yeah. That's exactly what I have here also.
Yeah. Oh, I can't really see. Okay.
Yeah. You could see, well, try to.
Yeah, it's very small.
Okay, so we took care of the problem, right?
Yep. Thank you.
Okay, no problem. Okay, does Ms. Ringel still have a question? Otherwise, I'll go back to the class. Okay, homeowners association is an expense account. It's like maintenance. I just said that make it separately because it's not the regular course of the business that we have. We have an office. We're going to meet people and offer them a website design and consulting, and probably pay $100 a month or something for cleaning. And all of a sudden, we're going to have a $2,000 bill, $2,500 bill. So we're creating a new expense account called the Homeowners Association. Okay, members equity 27,700 is fine. I don't know what you did to have members equity 940. Members equity should only be 570 at the most. So you have to see what's going on for $370. Okay, so that's again the question keeps coming up. Probably good to take a look at the debits and credits sheet to understand. Everyone's asking why, when there's expenses like property taxes or interest expense, owner's equity, Reuven's equity goes up. So in this case, when these expenses are happening, property tax, it's not an asset, it's not a liability. It's also a contra equity. Just like when revenue goes up, when income goes up, at the end of the year, it's going to cause an increase in the equity of Reuven. By itself, expenses, if the money is coming out of the bank, will reduce the equity. In this case, we're not taking the money out of the bank. It's being put in again by Reuven. So again, what does equity mean? Equity means the value of the ownership that the owners have, because liability. If I would, where's the share again? If I would just go on a Google search and I search equity, so equity could mean the quality of being fair or impartial. Right, equity, then the value of a shares issued by a company, that's equity. Now in this case, who owns who owns the equity? This is Reuven. Reuven has, that's the value that he has, as opposed to the liability. Equity represents the shareholder's stake of the company. Identify the balance sheet, right? So what is equity? The assets minus its liabilities. Okay, so going back to the QuickBooks here. Stop share. Let's see what question we have coming up. Okay, so again, the question, if Reuven's equity is not the same as members' equity, QuickBooks, the way it's designed, the way it uses the members' equity account is where it puts in all the profits of the year, or actually the previous year. So this year it's called net income, and we always said that the income statement restarts from zero. So how do you wipe it out? It makes actually a debit. It debits the income to zero, right? Let's say you have $1,000, right, on the credit of income. There'll be a debit to erase the income to zero because we have to start in the year zero, and the credit will go into members' equity. So the equity, that's members' equity. So members' equity is going to be a holding tank for the profits of the company. QuickBooks prefers to have a separate equity account for inputs or investments from the members, and that's why we call the member Ruvain's Ruvain. If there will be a second partner, it will be Shimon. If it's a third partner, it'll be Levi, or whoever it will be. Members' equity is not the entire amount. Members' equity is the accumulation of profits of previous years. And what is the current year? So before the current year, it uses the word net income. That's how it adds it in the balance sheet. Again, how do you change? You just overwrite it. So another way to understand this from a tax perspective is taxes are paid on the net income. Once you pay tax on net income, it gets thrown into members' equity. And that's an account where you keep you could have paid the taxes out of your own account or the company account, but you don't pay taxes on members' equity because taxes were already paid, right? So if I would take, just to give it here to see an example, go to the profit and loss. This year's loss is a negative 6490. It's a loss. That's the net ordinary income is a loss. It could have been a positive 6491 and you pay taxes on that, but in this case it's a negative. So this is going to start to come to zero again. In 2021, we start the year, there'll be zero sales, there'll be zero income, zero loss. How do we take care of this number? So we have to make an adjustment. We have to go to the balance sheet, and you'll see in the bottom there's the same number. Actually, let me share. I'm not sharing the screen, so let me do this again. On the profit and loss, we have a negative net income or a loss. Right? QuickBooks doesn't use the word loss. It just says net income, and it gives you either a positive or negative sign before the number of negative 6491. So what's really going to happen if you go to the balance sheet, it's going to deduct the 6491 from the equity. Because it was a loss, it's like if there was no, Reuven has to put the money back in to cover up for what was lost, or he doesn't actually put it in, it gets taken out of his 28,200. So he had put 28,200 into the company, but the company lost 6491. So what's really left in the company? 21,779. This is the combination of the leftover money from last year, what he put in this year, what was lost in the profits of the company in the regular course of business. The total value of the company is 2117 in equity. The total liabilities in equity as a whole is 182 plus 21. What's 182 plus 21? That's 204. And then again, you see here, what's total assets of 204 equals liability. And I could collapse this because this is all you have to understand in the equation. The equation tells you assets will equal liabilities and owner's equity. If I click it again, it'll give me the pratim, it'll give me the details. What are the liabilities and owner's equity? Actually, not so much. Just click on the arrow and it'll recollapse. It'll give you the details. But All you really have to know is that the total liabilities and equity is going to be the total of assets. Let me see any. Okay, I'm gonna just have one question here about Ruben putting in cash to have equity. Well, sometimes you have to put the cash into the company. In this case, he's paying third-party expenses on behalf of the company. So you don't debit cash and credit equity. The cash went straight out to the seller. So to answer the question, doesn't expenses normally decrease equity? Yes, the net result is that equity is going down, as I explained before. Initially, let's go back to the balance sheet. Initially, Reuven's equity is 28,200, 27,700 he put in, plus the $500 that he put in the beginning of the year, 28,200. But the expenses of the year, in this case, because it was a loss, that is actually going to drag his equity down. That's correct. And that's why his equity is going to drop to 21,779. If I would, as an example, move the report to a year ahead, so the company is not really pulling out of Reuven equity. They're going to pull the money out of members' equity. That's just the way it uses the profits from one year and the losses from another year all go through members' equity, because we want to keep track. What Reuven put in was 28,200. For all practical purposes, his value in the company is down to 21. But at the end, he might want to take a personal loss in an investment, and you want to keep track of what he originally put in years ago. So we don't take it out of his account every year. His account stays fixed. That's his equity, 28,200. But in the overall picture, if you look at what the company made over the past 3 years, here we're looking at 2019, it made $70. In 2020, it lost $64.91. So at the end of 2021, it nets out to $64.21. So that is actually dragging down his equity because of the expenses. Okay. Do we have any? I'm sure there's a lot of questions out there. Still digesting the information. If anyone has a specific question on the entries that we put in today, why it's one way, why another way, you could stay on after 9:30, and we'll address those questions. Let me see over here. I'll just give you a preview of what we'll be doing in the next class, which I sent out in the email. So obviously, as we can see, the company has really been in existence for over a year. As we saw, we had income from 5-ish Click from December 2019. So when we did this, we started this course in November. Obviously, like I said, QuickBooks has an option to have the default date as the current date. If you go to preferences, again, you go to edit, drop down in preferences, edit preferences. It gives you the option of using today's date as a default or use the last date entered as a default. So while you're still within QuickBooks, it's going to use the last date entered, but sometimes you go out of QuickBooks and go back into it, it might assume you can start using today's date as a default unless you choose otherwise. So with all the transactions we did before today, we're all in November because we started in November, we started making sales, and we started entering bills, with the exception of the one I pointed out that you have to put in the 5-ish Click for December 2019. Now, as I made the journal entry, I told you to go back to June of 2020, right, June 8th. So I'm also going to go back to May 25th. We're going to change the date. We're going to change the date when we're going to start making new invoices. We're going to have to, or sales, we're going to go back to 525. We also ran this question this summer. We put in items, leading up to Shavuos of inventory. We're selling Tikkun LaShavuos, or we're selling Megillas Rus. You can always try to tweak it and go from, sell Hanukkah Menares right now, but then have to start revising dates, revising items, and it'll be complicated. So we're going to assume we're going to go back in the next class. We're going to start doing entries from May 2025. It's all still in the same year, 2020. So it's not going to affect the P&L. It's all, the reports are still going to come up the same. The only thing we could do now is in order to start doing inventory, we're going to start selling items, because we so far learned how to invoice customers for service. Remember, for the first class that we started in QuickBooks, we created service items of housekeeping, of consulting, of bookkeeping and web design. But now we want to start selling items as well. We're in the business of buying things and selling things. So this is going to entail enabling inventory. So QuickBooks number one will keep track of things you sell. You could some stores have things which they just buy and sell. They don't keep track of it. But we want to learn how to keep track of the inventory. We're also going to have to create inventory as it comes in. The only way to create, so we're going to all do this in the next class. We could edit the preferences, and I'm going to show you, we'll do it again next class. You'll edit preferences to the inventory, items in inventory, and you go to company preferences, and you have to check inventory and purchase orders active. That is how we'll be able to keep track of inventory. So this is the Hagdama to the next class. I don't see a second here. -15. Okay, so we're going to leave the inventory for next class. We'll stick around for Q&A, voice enabled, and we're going to try to give everyone a chance to ask questions. So we're going to address one, and then if we go down the line, then we'll again, I'm not, we'll start with Shimon.
Yes, hi.
Yeah.
Just curious to understand what goes into the category of debits and what goes into credits. Why is the income always a credit versus, let's say, your assets increase is always a debit?
Yeah.
What makes it go into credit?
Because they're two different sides of the equation. Let me share a new screen here with you. What this didn't open up here. Second. Another PDFs. A second, I'm just loading the PowerPoint again. Okay, where were we in the? Okay, let me go down to the page. Okay. Let's see if I can enlarge this. See, imagine what's going on. You have an asset, and okay, we said, where does the company get the asset? So either it borrowed money, it borrowed funds, or the owner put in equity. So so we said that if it's two opposite sides of the equation, then what's a debit by one is a credit by the other. So if the assets increase by that means you could say theoretically you could have had the reverse. You could say assets go up by a credit, owner's equity go down by a debit, but that wouldn't make sense because people think in terms, I put in $100, I have a value of $100 in the company. So whatever I put in has to go up. So if we focus on the owner's equity and liabilities side, right? Whatever you put in, like if I borrowed $1,000, now I owe $1,000. So whatever went up by a credit will go up with a debit on the opposite side because there's a right side and a left side. So that we always say debits on the left, credit is on the right. Now, owner's equity is affected in three ways. One way has expense. The company's going to have expenses. One way it's going to have income. And in between, it's called the drawing account, which we just discussed previously. So when you make revenue, what happened if the company made another $5,000? So it might have gone to the bank. So the bank has now another $5,000 plus. But who owns that $5,000? It's not a liability. You're not going to pay it back to someone. The company earned it. So the same way the person's value goes up by money that he invested, his value is going to go up by profits earned. That's why you're in business. You want to grow your money. You put in 5,000, then you want to earn 5,000 or more. So the revenue accounts mirror the owner's equity. Whatever you put in brings up your value. Whatever you make in sales bring up your value. And the expense accounts, it happens to be that it matches the assets, but it's not because they are assets. Expenses are dragging down your equity. It's the reverse. You have an expense, so your value is less. So what would bring up your value as a credit, as a plus? When you bring expenses, it's bringing it down. So money is going out. If you write out a check to Con Edison for $100, so where did that check come from? It came out of your bank. So it was you're gonna minus the asset bank. If you credited bank, so you have to debit the expense because the credit matches the debit. So did you follow what I'm saying?
Yes. So let's say by
Let's see,
income
Yeah.
increases is a credit, right?
Revenue increases a credit. Sales, for example, sales are increases as credit. Yeah.
Sales are credits. Now, what goes on the opposite side?
Oh, so it depends. If it's cash, so the debit is cash, and the credit is sales. If it's an invoice, then the debit is account receivables, but it's still an asset.
Again,
That's what we gave an example here. You have not on this page, but that's what you can't just look at one page. You have to. What are assets? Assets could be cash, could be account receivables. It could be inventory, because when you buy $10,000 worth of masks, for example, it's not an expense. You're going to resell it. So inventory is an asset. You just change it from cash to inventory. Supplies might be an expense if you use it all up, but at the day you made the purchase, it's still an asset. So what was your question about?
okay, when I make an income, when I make a sale,
Yeah.
is my income increases, meaning I put it on the credit side. What's going to go on the opposite side?
Okay,
As a debit.
so one second. So what I explained before is that a lot of things you do is QuickBooks does automatically. That means if I would be in QuickBooks and I would make a cash sale, I wouldn't be doing journal entries. What I would be doing is let's go back here. You go to customers. You go to customers, enter sales receipt. When you enter sales receipt, right, you're gonna put in what did I sell? Did I sell housekeeping quantity for $20, whatever it is, right?
Yeah.
So that's how you're entering a sale. You're not doing debits and credits. When you're doing QuickBooks does that automatically. It knows how to do it. So I gave you an example in the sales, and that's why I did this before. When you have Holtzklapper, he's not an invoice, he's a sales receipt, right? You see Holtzklapper?
Yes.
If you would go Control Y on Holtzklapper, it's going to tell you made a sale for what's it called? Why is it deposit $75 here? Give me a second. So, debits and credits, yeah. So what happened? The sale is $75. That's a credit. Income went up. What is a debit? So it didn't go to the bank yet. If you would put the money, never goes directly straight into the bank. The money goes into what's called undeposited funds. That's where QuickBooks puts it, and that's why you have to go to a separate step called banking, and make deposits to actually put it in the bank.
So it's only
As
considered to be a debit. It's only a debit until it gets to the bank.
No. There's always a debit and a credit. Always a debit and a credit. In this case, what is the asset? The asset is undeposited funds. When you're in the store and you make a sale by cash register, so they made sales, $75. Where's the money? The money is in the cash register. QuickBooks calls it undeposited funds. You have to actually go and make the deposit, take it out. Then what you'll do is you're debiting Chase Bank and you're crediting undeposited funds. You're moving out from one asset into another.
Mm-hmm.
When you make the sale, it's revenue, it's sales, the sale credit, and debit the asset undeposited funds. You put it in the bank, you get a credit on deposit funds, you debit bank. As opposed to an invoice, when I make an invoice, it's the same exact thing. It's debiting account receivables. That's an asset because I didn't get the money yet, but you could. There's value. People buy account receivables and they collected it. People who don't know how to collect or need the money right now, they might sell it for discounted, and people buy it. So you made sales 225 and you debit account receivables. When you receive the payment, what happens? It's going to credit the account receivable and it'll go debit on deposited funds. When you make the bank, it's going to credit on deposited funds and it's going to debit bank. That's how the automatic works in QuickBooks. When we have to but we have to have a good understanding because there are times we have to do journal entries like we did today. You're putting assets on the books.
Right, so I'm saying I want to understand, so why is the asset always considered to be a debit and an income a credit?
Because again, because the income is a credit and it's the owner equity side, the asset is always the opposite. So the one way to say it is, to understand it is, the equation is assets on the left side, liabilities and equity on the right side.
Okay.
Therefore, whatever goes up on the left side, plus on the left side, and plus is on the right side. Right?
Again, plus on the left side.
Assets are going up on the left side because assets are on the left side of the equation. Liabilities and owner's equity are on the right side of the equation, so it's going up on the right side.
Right.
Oh, I'm sorry. I thought again, I was demonstrating on the paper here. Here, you see assets is on the left side of the equation.
Mm-hmm.
So all the how does it go up? How does it increase? How you get a plus on the left side, and debits are always on the left. Liabilities and owner's equity on the right side of the equation. So how does it go up? The pluses are on the right side with credits.
Can you send me this?
We sent this all out. This you got part in the slides after first class. So
I never got the email of the full, all these papers.
we sent out these three papers. This
Oh yeah, this we got, yeah.
this one, and this is the third page. These three went out.
Mhm.
Okay, so you can either think of it debits are left and credit is right, or because assets are the left side, it goes up on the left side, and then liabilities and equity on the right side go up on the right side. Revenue brings your equity up, so it matches. The debits and credits match. Since expenses bring your value down, so it goes down on the opposite side of owner's equity. Drawing is the exact same thing. I'm already pulling money out of my account. So it's not an expense in the tax sense, but it is bringing my equity down. That's what these are called temporary equity accounts. Expenses, revenues, and drawing. At the end of the year, it's going to all balance out.
Great.
Okay, so it's not just this is an explanation to the whole class.
Yeah,
You have
can
to ask
I
the question.
request can I have the full PowerPoint to see, or?
This is all it's negated for debits and credits. The other parts of the PowerPoint, I'll show financial statements. So this account, the equation is there on the top of the third
Next
page.
page, page 6.
What's page 6? You want to know what's assets and what's
Right.
Yeah, I can send it out.
Right.
One is equity
Thank
is
you.
cash capital invested, article invested, and what should really be added to this actually is profits of or business profits. Brings it up. Okay. Let's see who else has a question here.
Yes, hello.
Yeah.
Going back to the profit and loss, I have negative 6497. So I wanted to know, before I realized that I was by this month to date, so that's why I only had negative 701. But then where was I supposed to move it to this fiscal,
Again, this fiscal year or this fiscal year to date? Either way.
fiscal year to date? Okay, so this fiscal year, I ended with 6,197. I have like $7 more.
So I'm on the profit and loss. Go down the list.
What's
Look at the
So
list.
I was looking. So for example, by meals, could you show me your profit and loss again?
Oh, yeah. It was. I have to keep on going back here.
So I have totally different things. Let's say by, let me just see. Okay, so let's say meals and entertainment, you have what, 120? What does it say? I can read it. Meals and entertainment, you have 120?
Yeah, you want 120.
So by me, I have 196.
196. Then you didn't put the number. We have 76 and 44. What did you put in? You have to go back to the curriculum. What was the debits and credits?
So how do I go back to that? I click on meals and entertainment?
Double click on it. Yeah, sure.
Double click,
And you'll
that's
see
what
what's
it
inside.
is?
Mhm.
No, I'm double clicking, nothing happens.
No, you have to go to the number, not the
Oh,
word.
to the number,
Yeah, you
okay.
see where the arrows are. You see the
Okay, got
arrows
it.
tell you where they go into it.
Okay, so I have 76 for Essence, 120 for Super 13. I have
No, it's 44. The total is 120. You probably might have looked what
One
times the
second.
total one.
by the debits, I have 76, then I have 44 for Super 13, then I have 0 for Super 13 and 70.
No, you have the same thing here. It's the debits are 76 and 44 is 120.
Right,
The
and then I also
balance
have
is
five-ish click.
what? What's five?
I have 5-ish click also,
What do you have for him?
76.
You paid 5. Click something.
I don't
Delete him.
know.
He paid
Okay.
you $70 last year. No.
Okay,
you just
so
double
we have
click
to
him and-
delete him?
Yeah.
I have to delete him.
Yeah.
How do I do that?
1 second. Okay, make sure. How you delete him? You double click on it. You just go for the next step.
You double click on what? On
On
the,
five-ish clicks number. You had 76,
That's on the
44,
number.
and again 76.
okay, you double click and then what do I do?
You're in a check. What are you? It's a check to 5-ish click.
It's a check, yeah.
So there's an X. There's an X on the. You would have it on the second row. You would see an X.
The second row of what?
Or edit, delete check.
Can I do revert?
Revert is only if you made a change, and it'll bring it back to where it was. You want to delete
So
the check.
So where
Just
should I
edit.
go?
Go edit. Drop down. There's delete check. If you're in the check.
Edit. And
So delete check to 5.
yes, I see, okay.
Okay. So now, is your negative?
Okay, so now it was erased, okay.
It prompt you to refresh your data now.
Oh, save and close?
Yeah.
Okay.
So they said actually you just exit out because
Okay,
you
so
didn't do
then-
anything in that one.
Then I also have like another check by the debit. I mean, for Super 13, I have 0, but then by the balance, I have 120.
Because there's no balance, there's no credits there. It's
Okay.
only expense.
So
There's no
the-
credits. The checks are always debits. They're expenses. Expenses go with debits.
Okay, so the total should be
The
190.
the only way you would have credits is if you had expenses for meals and entertainment, and someone gave you a refund. You would have a credit, which is a negative expense, which is a credit.
Right, so you have 196 for meals and entertainment?
No, it's 120 because you deleted your 76 to go look.
Because it's still showing
You have
190.
to refresh it. We go refresh.
Where do you go to refresh?
Right, the second line. There's a refresh. Right under the help button to the right, there's a refresh.
Yeah, okay, I see. Okay, okay, so now it's 120. Okay, great.
So what's your net income?
Okay, let me go back. So it's 120 now, the total.
Not that. What's your whole P&L? When it's your whole P&L?
Okay, so now let me go back to that 1 minute. So I go back to, where is it again? In reports?
It might be open on your window. If you look at your drop down, see if you have a profit and loss report.
Okay, I'll just reopen it. Okay. Okay, so now let me just see. So the meals are 120. The office supplies, I have 505. What do you have?
No, you see, you only have it's only $177.
So how do I get to 505? Let me double check. Office supplies,
Well,
I have.
take
Okay, so I have a bill for electric bill for 328.
yeah, it's 328 office supplies.
Again, I'm sorry.
Belongs in utility. You got to recategorize it.
Mhm,
See, double click on it.
yeah. And
It's actually it's not just that. It's yeah, it's Con Edison. So you double click on Con Edison, and you go to the account at the bottom, and you change it to utilities. But again, before you go to details, what's your total net income?
okay, 1 second. Let me go back.
Let's do it this way. Just do this month to date. Do profit and loss this month to date. We'll filter out the expenses of the
My
house.
total net income now, 1 second, for this month to date,
Yeah.
negative 721.
No, you're missing $70. So go down the list. You have advertising. What's your sales, first of all?
I said
Oh, I know why. Because you're $70 from 5-ish Glick.
1780. 1780
It's
on my sales.
1710, not 1710. Again, you have to follow exactly what it says in the curriculum. We said particularly that you have to enter 5-ish Glick as a 2019 sale. You see that on page.
Second. So what could it,
Wait, the
what's
other
the
click-
70 off? What's the 70
no,
that's
no,
off?
it's you have 70 extra income. That's why. Not because your income. Your expenses are 2501. Your problem is your sales is 70 too much for this month.
Mm-hmm.
So I'll say, do you have the curriculum in front of you?
Meaning, what's the curriculum?
I email sheets that you with the data you're going to enter.
I don't have it in front of me, no.
Okay. I want to show you what you have to look on it for. You have to pull it up. if
What you had started off like today, like the,
Not today. No, it's the first. Whatever I saw in the first class was for the first 5 classes because today's class number 6. So I started a new thing, but in the first 5 classes, I sent out all the information before.
okay. So now what? What are you asking now?
Look at the curriculum. See what does it say for 5-ish Glick? What's the date?
Okay, so where do I find that? By customers?
Before look in the email from me.
Oh, okay.
While you're looking at that, let me see if there's anyone else.
Okay, the one that says chapter 3 accounting for inventory?
No. That's today's. Look for a previous email. I'm gonna just let someone ask a question. In the meantime, while you find the email, and I'll walk you through the previous PDF that I sent out.
What?
The previous email, like from 2 weeks ago,
Oh,
or last
2 weeks ago.
or beginning of last week. I think I sent out a revised version. So you don't have to go back that far.
Okay, I found something. The one that you write due to unforeseen extenuating,
No.
even before that.
That was only a half a week ago. That was on Tuesday, Wednesday. I mean, like before class or two ago.
Okay, let's see.
1 second.
Hello?
Well, yeah, Ms. Meltz, you have a question?
Yeah, I asked a question before. When you did your profits and losses, mine was different. And let me get to my QuickBooks.
Okay.
Okay, so my QuickBooks, my
Look at
balance.
this month to date. Take this month to date, so I
This,
don't have to mix it up
date.
with all the house
okay,
issues.
so this month to date, sorry. I'm gonna just look at mine and not the Zoom. It's hard to look at both.
Okay, that's fine.
So for this month to date, I have 940 for members equity, Reuven equity 20
Wait. You're looking profit and loss. You're looking balance sheet now. What's your question?
balance sheet.
You want balance sheet information? Okay, so let me open it.
So basically the equity part seems to be off.
Well, if the equity is off, then the P&L is off because they're tied in. One
Right,
is-
so I'm trying to understand, because I did follow everything you did today, and the members' equity is 940.
No, this month to date. Let's see.
It shouldn't be 940, it's too much.
1 second. We'll put it this way: if you go on the balance sheet this month to date, it's still going to show everything. You didn't do today's entries, did you?
I think I did, yeah.
No, because on the balance sheet, it's going to show like hundreds of thousands of dollars because that's the difference between balance sheet and P&L. P&L will only show you the sale, the income and expenses for this month. Balance sheet is a cumulative picture. So even if I bought a house and I put in money half a year ago, it's still going to be here.
Right, but my number,
So again, what's your assets?
okay, let me get to my page and not yours, 1 second.
Yeah.
Okay, fixed assets, I have furniture and equipment, 2079, summer home is 202,000.
Yeah.
Total fixed assets is 204,079, total assets,
What's total assets? Total assets.
204,562.
Okay, so the top part is correct. Now,
Right.
so obviously, your bottom part is also equal to the number. The question is if you got all the line items right. So what's accounts payable?
Accounts payable is 704.
Correct. Your credit cards.
Total credit cards is
Yeah.
$2,079. Total current liabilities is
Yeah. Yeah,
2,700.
that's fine. Okay, and the mortgage price is 180,000.
180, right. So
So what's
the
it- now-
equity, I guess I put them in the wrong lines, but then when I double click, like, do you want me
Okay.
to double click on members' equity?
No, well, what do you have? What's the number showing members' equity?
940,
And by Reuven's equity?
25,700.
25,700. Okay, so this doesn't add up. Okay, double click on the 940 number. Or
Okay.
actually, I mean, you could go back to the journal entry. It's gonna bring you back to that.
So you want me to go back to journal entry? Okay.
Yeah.
How do I go to?
It's a different guy.
What? 1 second, Eli, I'm on mute. I'm not on mute anymore. Sorry.
Yeah.
Reports, journal, wait. Report center, right? No.
No, Airport Center. If you're in Reuven's equity, yeah, just double click. This is a simple way. Go to Reuven's equity, double click on it.
Right? And it has,
It's going
okay,
to show you not okay because you're in this month.
it's
let's just
basically saying review,
just take-
25-2, yeah?
Yeah, press all. So it's going to show you the journal from June 8th. Like the
I
date,
just-
the period should be from all.
I clicked on Reuven's thing and it just says Reuven equity 25,200.
Okay, pick the dates of all.
Like dates,
The period is not this month, it's all.
okay.
Your general journal, you put in, you show June 8th.
It has summer
Right.
home, yeah.
Okay, double click on that general journal.
Right.
and it's going to bring you up like a register, double click again.
Yeah.
Now you'll be in the same journal that you saw before.
Now I'm in the journal.
Right, double click on that and it'll bring you up the journal. Yeah, the journal, you'll be back to the original journal entry if you double click again.
Right. Okay. QuickBooks.
Okay. Okay, let's
All
go
right, so I
down.
have summer home is $200,000 debit.
Okay, yeah,
Removing equity is $20,000 credit.
correct. Yeah, what else do you put in?
What?
Yeah, what else?
Summer home is $2,000 for closing fees debit.
Yeah,
Removing equity is $2,000 for closing fees.
right.
Chase mortgages is a credit for
Mhm,
180.
right.
Homeowner equity 2,500, and it's in debit and in credit.
What?
The homeowners, not
No, it's not.
homeowners association.
So you're wiping yourself out. It's not a debit and credit to HOA. HOA is
I
a
thought I had
debit.
to do that.
What?
I thought I had to like make
No, the credit is equity. Where's the home? Where are you getting the money for the homeowner association?
from removing.
Right. So you have to credit roofing for 2,500.
Oh, so I didn't do that.
So you would have wiped out the expense. It would be non-existent.
Okay,
So you wouldn't even
removing
have so your expenses would have been off also. That's like because you don't have this equity of roofing 2,500, you wouldn't have the HOA of 2,500 on the P&L.
right.
Right now, you have an expense 2,500, and you have and you have the equity of 2,500 because
Yeah.
that's what it is in this case. Each line item is going to cause such an effect. If you put HOA 25, they're both going to be lower.
So right now there's homeowners equity, not homeowners equity, homeowners association. I'm sorry,
Yeah,
homeowners association $2,500 in debit.
right,
And then Ruben gets the equity, he gets the credit 2,500.
right. So that the rest will be the same. Yeah,
It's 2,700. Property tax, Ruben equity is 2,700.
yeah.
Interest expense is 500, and then credit $500 Ruben. So let me do save and close,
Yeah.
and I'm gonna change it. Record. It's just asking me a lot of different things right now.
So at least we took care of the roofing equity part. We'll still to figure out.
But Ruben equity is still 28,200.
Good.
Yep.
But your
Good.
members' equity is off. Still, it's 940.
Right, so I'll double click on it, and I
You have to
have
go there and see what's going on there.
I have 3 invoices and 1 sales receipt.
That doesn't go to. How
Well,
does your invoices go?
It's web design for Rabbi Cohen, 300. Balance is 370. Members equity is 70.
Okay, so I tell you why. You put your dates from last year. That's why. You have to go back to the customer center.
Okay,
That's what it does. That's members' equity is last year's sales. That's how it comes. That's how that's why I divided Reuven's equity and members' equity for that exact reason. There's different ways of accounting.
so right now I'm in customer.
Customer center, Rabbi Cohen.
1 second, it's just hard to look at my Zoom and your Zoom.
Okay,
Okay,
fine.
I'm in customer send information. So invoices, what do you want me to do? Rabbi Cohen.
Yeah. What's the date of his invoice?
So 1 second, it just gave me transactions.
Don't look in transactions. Stay at customers and jobs.
It says about, the thing is when I double click on it, it just,
Go again. Stick to
Cohen,
customers and jobs.
it's November 4th, 2020.
For how much?
Well, it was total 600 and you paid 400, so the balance is 200.
Okay.
This was all fine, I think. I mean, I
What?
don't know.
Remember?
I think like, yeah.
There's how much are we off by? You said it's 940
Yeah, I don't know why.
minus, we only have 70. So you're off by 870. So the look at Ploni Amoni. What's his invoice from?
1 second. Colonial money. So is it colonial money? I don't know what just happened. Colonial money.
You must have saved something. That's why it made a beep. So I don't know what you changed.
I hope I didn't change. Now there says nothing. Like, okay, 1 second. Yeah, I'm just gonna write save and close because I don't know what I did. Now it says nothing. Oh, shoot. It says open balance. If I go to the right side, it says open balance 600.
For who?
Colonial money.
Open balance 600.
Yeah.
Start from the beginning. What we never the number wasn't 600, it was 670. But anyway, what is the date of Polonia Money's charge?
November
Invoice.
4th, 2020. 600 balance due.
What's the payment you received?
670. Well, it says recent, recent transaction 670. Payment. 1270. I don't get this.
So you made two invoices, one for 600 and one for 670.
Mm-hmm.
So delete the invoice for 600.
I have to get to it. 1 second. I don't even know how. Let me go to the payment.
If you were in customers and jobs, would you see two invoices?
If I go to customer payment for Colonial Ammonia, I have two bills. I'm gonna try to delete this.
You see,
Yeah.
so you double click the
delete it.
invoice. So it's look in column again also. Do you have two invoices for him?
Well, I just deleted one of them. Let me go back to maybe the balance sheet will be okay if I did this, or no. Let me see. I'm gonna do balance sheet.
Your reports, company
Okay, so
financial.
if I'm doing- Now I'm gonna do balance sheet for this month. Members equity is 670.
So you still offer 540. Let's see. No, you have $600 too much. So double click on the 670. 1 second.
Yeah.
Double click on 670 and check the date to all, like I asked you before. So it's
Date.
going to show you where it's coming from. Yeah.
I don't have something that's exactly 600. I have Colonial Moni. In terms of the credits, well, they're,
Again, just stick to one thing. You
Yeah.
double clicked on the 670, right?
yeah,
And you select the dates to all.
yeah.
So what's it showing up on the members equity? What's the entries? Closing entry?
Closing entry 70. Invoice Colonial Moni 300 for credits, 370 for balance. Yankel Chaim is 225.
In members equity?
No, an invoice.
No, the members equity.
The total members equity is 670, which is closing entry
How many-
70, 300 for Colonial Moni, Chaim Yankel 225, and then a sales receipt for bookkeeping 75.
And what is the dates that's showing up over there?
Closing entry is December 31st, 2019. Everything
Yeah.
else is in November of 2020.
It doesn't even belong to members equity. Let me see.
I don't know. Let me see your, what's,
1 second. I'm
you
gonna.
don't, all my you have no invoices, I do.
I don't have any invoices here. I have to actually log out a second. A second back here. Hello?
Yeah, I'm here.
Okay, this I have to log back out, log back in. So, okay, so where are we looking now?
You have, when you go to members equity, I still have invoices. And you don't.
Right. A second. So those invoices have to come out of members' equity. Members' equity is only $70. So what happens if you double click on the invoice? What's going to show you?
1 second. When I go to the, okay,
How about this? Before the balance sheet comes after. Let's start the P&L first of all.
okay, so let me go to reports.
Yeah, there'll be
The loss is 2061 net income. Negative.
this month. This
This
month.
month?
Yeah,
This month to date? Or just
this month. Just take this.
2061.
What?
Negative 2061.
This month?
Yeah, let me try to get, it's
No.
very,
What's the sales for this month?
1 second.
What's this month's sales?
1710,
Good. What do you have for expenses advertising?
250. Oh no, I'm reading from yours. This is why it's so confusing.
No, look at yours. I don't look at me.
Okay, sorry, this is why like I try to follow both at the same time and then that's, okay, so for sales I have 440, not 1710, sorry. I was reading from yours.
So where's all your invoices? Why are your invoices in members' equity?
I don't know. I wish I could just start over and do, I don't know. I try to follow both screens at the same time, which doesn't always end up well. Like right now, I was reading yours thinking it was mine.
Right. So if you double click on your sales, you're gonna have only a couple of people here.
If
We
I,
said you had $400. You said. Well, how much is the sales?
441, 440, I only have two. I have Mrs. Cook and Plony Almoni.
But that's all. Mrs. Cook is 140. Plony Almoni is supposed to be 670.
Yeah, I have 600, 300.
So that's to be. You have to match you have to match the entries of the curriculum. So I guess you have to walk through the sales and start doing. I mean, next time we're gonna be doing inventory, which inventory it's gonna be a separate part. It's a separate part of the P&L on the balance sheet. We should work on fixing over this section.
All right, so I'll go through the sheets.
Go invoice by invoice, and I guess double triple check that you're putting the dates and numbers right.
When we're not on Zoom, it's hard to.
Listen. I know that technical. I have my own technological challenges as well, and giving the class, it's like I can't just take a look over a student's shoulder and see what's on the computer. I have to imagine what you're reading back to me.
Right. All right. So,
So-
I'll figure it out. I'm not too. I think I just.
But what's it called? So obviously, the balance sheet members' equity is really, like I said, is the net income of last year. This year's net income is showing up on a separate line. So when you're off on members' equity, I have to go, and then we have to start with the profit and loss to see what's happening. And you see that the bigger problem is in the sales. When everything falls into place, then you can go back and see what happens with members' equity.
Right.
Okay.
So I'll figure it
So-
out. Thank you.
Yeah, wish you success in working through it. Yeah,
Thank you.
no problem. Okay. Who else is here? Hello?
Yes, okay. So back to the profit and loss. So now I'm good. I figured it out. I moved over the expense to where it's supposed to be. So for for this month, I get negative 721, which you have. But what,
No, I have negative 791.
whatever,
so-
yeah, I have that too. But now for the fiscal year,
What is your sales? Your sales is how much?
the sales are 1710.
Yeah, because the $70 have to be moved back to last year. So
Right, that's what I
originally,
figured out. So I moved it
Yeah.
back exactly. And then
Okay.
it was fine, right?
yeah.
Right, but now, when I go to the fiscal year, what do you have as a total expense?
Okay, so now that we got the first part right now, whatever's be different in this fiscal year will be as a result of today's class. So that's why I first wanted to get this month. Now I go this year. This year is a negative 6491.
Am I able to see your screen of profit and loss?
Yeah. Let me share that right now. What is your negative? I mean,
So 1 second, what the total expense?
no. What is your total negative netting? Your total expense, let's say.
So I have 8,201.
Perfect. That's exactly what it is.
It is what it is, but you have something different.
No, you're looking at me. You're looking at you.
I'm looking at you now. You have, I can't really read, but it doesn't look, it looks like, what do you have?
I said 8201 is expense.
Oh, yeah, I don't know. To me, it looks like a 6. It's very small. Oh, so then it is perfect. Okay, great.
The net income is negative 6491.
Oh, so I see. Oh, okay, fine. The total expense is that. And how do you get to the net income? Because by me, it doesn't show the net income.
Where? On the profit and loss?
Oh, wait a second. Maybe my screen is not fully open.
It's the last line.
Oh, yeah. Okay, when I
It's always like that.
open the screen, then it shows it. Okay. So then it's
Right.
perfect. It's good.
Yes, yeah, and this net income line will show up on the balance sheet.
Okay, perfect.
Okay, and your balance sheet, you have members' equity, the right lines. You told me before.
Let me just double check the balance sheet, right?
Yeah,
So what did you want me to check there?
the equity section. There's 3 lines: members' equity, Reuven equity, and net income.
Right. So where is it? 1 minute.
It's the bottom section.
Right. Okay, so what do you want to know? The total
What-
equity?
What's your 3 numbers? What do you have for members' equity?
Okay, members' equity is 570.
Okay, so we told everyone to move the $500 okay, what's Reuven equity?
Reuven equity is 27,700.
Okay, and the last line is whatever the last line is your P and L, the net income. Whatever we showed on your P and L comes over here.
Right,
So
so
if you want, you could double click on the 570 and reclassify the $500 as Reuven equity.
500. So the deposit.
The deposit, you could put it, really, it could go to opening equity also, really. You could have a fourth, like I have opening equity 500.
So I click on the 500
Yeah.
and then,
And then you'll reclassify it to Reuven equity or open equity, whichever one.
so instead of members' equity, I should write,
Just take it out of members, because members is used for previous profits and losses, not for contributions.
okay, so I put it into Reuven equity.
Yeah.
Okay.
Yeah, probably next class, I'll probably tell everyone to put in opening equity.
Save and new, save and,
Yeah.
I'm sorry, save and close.
Yeah. Okay, does anyone else, let me see if anyone else here has a question here. There's no open questions over here, I see.
Okay, so what should my profit, what should the profit and loss be now?
We know what it is. It didn't change. We didn't change profit.
Okay, so it's good. Okay, fine.
The
So
profit and loss is,
why did you want me to move that 500 then?
I explained that the account called members equity is tracking the profits and losses from year to year.
Right?
The Reuven equity account tracks the contributions from the owner, what he puts in and what he takes out, nothing to do with the profits and losses. It's a separate account.
Mhm.
And we also discussed what's a drawing account, but we didn't do that today.
Right.
Where's the participants for Q&A? Oh. I guess the other question I could see. I think he was answered. Okay, I don't see anything that's. I don't know. Someone told me that like a 4861. Okay. Thank you very much for participating and looking forward to the next class. Mhm. Last call for any questions.